All right, well, what I'm going to do, I'll kick off the actual introduction and presentation. We will have, with all webinars, we'll have a few latecomers and drop-ins and drop-outs as we go with participants. But first and foremost, thanks everyone for joining us on another ATLC webinar. Today's all about helping you to improve cash flow, to reduce profit erosion, and to really try and, as the name of the webinar suggests, to reset after the COVID-19 pandemic and how it's had such a dramatic impact on all of our economies and businesses. So we've lined up an amazing array of experts for you. You can probably all see them in front of you. And they're going to talk about some advice, very small 10-minute windows each. So we're not going to go into a lot of detail. The purpose of today is to give you overviews, and then I ask all of you to reach out with your particular situation, circumstance, or questions. We will have a Q&A session at the end, but if you've got a particular question for your business or your situation, you'll have all the contact details of our experts after the event, and I encourage you all to reach out to them individually so you can discuss your specific needs, and I'm sure they're all more than happy to help you on a one-on-one basis. So before we kick off, I'm going to ask all the panelists to just do a quick round the room, virtual room, and do a quick introduction to themselves before we kick off the actual webinar. So thanks once again. I'll start with yourself, Matt Wilson from Pitcher Partners.
Thanks, Lawrence. It's Matt Wilson. I'm a partner with Pitcher Partners Consulting. We're a full-service accounting firm focused on business advisory as well as commercial and financial consulting. One of my backgrounds and specializations is in commercial and financial advice to businesses that are looking at decision making, and that spans the gamut of supply chain management, decisions around stock, demand management, as well as overall cash and profitability within a business. So hopefully I'll be able to cover some of that today. Thank you, Lawrence.
Looking forward to it. Thanks, Matt. Kevin, I'll ask you yourself to give a quick intro, please.
Sure. Yeah, so my name is Kevin Leong. My company is Lendcap. What we do is tailor-made advisory funding solutions for businesses. We cover things like trade finance, debt restructuring, equipment finance, and performance bond setup. Background is I'm a CPA and also been a banker, commercial banker for ANZ for the last 7-8 years prior to this. So our firm is just dedicated to helping businesses work out the cash flows and how we can assist them throughout with the funding needs.
Thanks, Kevin. James, over to you, mate.
Yeah, sure. Thanks, Lawrence. James King's my name, State Manager with AFEX Australia here in Victoria, also looking after SA and Tasmania. Our business effectively sends money everywhere. We move money here, there and everywhere, but where our key core focus is really around risk management and helping businesses look to mitigate the unnecessary need of FX risk on a business and helping them come up with strategies so that they can overcome that. I'm a qualified financial planner, and as such, that sort of leads into I guess the advice strategy that we look to provide our customers. But I've been in the FX game for about 10 years myself.
Fantastic. Thanks, James. And last but not least, Phil Smith from EFC.
Good on you, Lawrence. Thank you very much, and good afternoon, everybody. Phil Smith, Export Finance Australia. I have a background in banking, corporate finance here in Australia with 3 of the major banks here and some experience over in the UK and the USA. Joined Export Finance about 6 years ago, and we're all about helping Australian businesses with access to export finance.
Fantastic. Thanks, Phil. Thanks, panelists. So the format today for everyone who's joined or recently just joined, we're going to have a 10-minute segment from each of our experts, and at the end we'll have another Q&A session where it's basically a roundtable discussion that all the panelists can chip in and answer any questions you may have. But as I said at the outset, we are going to try and keep the time limit quite strict, so 10 minutes each. So all your questions, please send through or wait till the end and we'll cover that off where we can. If you've got a particular situation or question you'd like, you can always reach out to the panelists on a one-on-one basis after the webinar. This webinar will also be recorded and will be put on the ATLC YouTube channel and a link shared with everyone as well. So you can use it as a resource. So without further ado, we're going to kick straight into it. And Matt, I'll ask you to kick off and set the scene and share your initial expertise. Take care, and we'll see you in about 10 minutes.
Thanks, Lawrence. Hopefully everyone can see my presentation now. Suffice to say, over the past few months, it's certainly been some challenging times for businesses. Industries are certainly doing it tough, and there are certainly businesses out there that are not quite seeing the same impact as those organisations which have seen demand drop off. This sort of makes generalised statements difficult in 10 minutes, but over the next few minutes, I think I'd like to cover three main topics. Firstly, I want to talk about the demand side of the equation, and that sort of leads us naturally to some points to consider for supply chain management, and overall I'll wrap up with a couple of comments on cash and profitability. If we firstly look at the demand side, to me it's clear that there is significant uncertainty and volatility in the markets. Overall retail sales have jumped in March by 9%, and they dropped around about 17% in April, and then picked up again in May. In other industries, we're seeing spending during lockdown increase, and other industries it seems to have dried up overnight. If we think about businesses like tourism, to me, what that tells me is that there's a significant unknown on a month-to-month basis, but also as we start to come out of this COVID-19 period, what the market's going to do, certainly when the government stimulus is removed or reduced, is really critical for businesses to start to understand. To me, that sort of leads a few things around demand management. The first is that businesses should be constantly scanning the market for information that's going to help them understand what's going to influence demand over the short to medium term. That provides them indications on what demand might look like, both from a volume and a pricing perspective. That should then allow a business to be set up to look at demand modelling in a more discrete and a more unique way. Traditional models don't necessarily work where you're using trend analysis or prior historical situations to forecast out what demand might look like moving forward. By doing the market scanning, it should give you a range of possible scenarios and possible outcomes to start to consider from the demand side of the equation. What's really important, and what we do when we work with businesses, is take that information and then look at it from a scenario perspective across the whole of business and across supply chain and inventory management, and ultimately what that means for cash requirements and profitability in the business. So Lawrence mentioned the profit erosion. Certainly during these times, profit erosion comes from the supply side as well as on the customer side. If I take that forward and think about it in the context of what that means across the business and across supply chain issues, the first one that sort of I naturally go to is inventory management. We're seeing industries such as the fashion industry, for example, that's had quite a bit of stock build-up during this period. That's going to increase holding costs, and it's going to look at the need to understand how that stock turn will occur in the months ahead. Fashion is often has a seasonality to it that you need to take into account. And if you've missed a particular season, then how that stock's going to look moving forward is pretty critical for the business to understand. It also has implications for stock reordering and the supply chain management needs. And the business needs to look at this and constantly adjust to this and adapt to this. Those organisations which have been able to adapt and understand what demand needs are able to look at how they're managing inventory both during this time but moving forward. We've seen some of our clients in industries which are experiencing the inability to get stock into the country, and that's making it difficult to understand when that pent-up demand is going to unwind. An example of that is in the transport industry. It's difficult to get a chassis into the country to build a bus. What this means for businesses, in my view, is that it's likely that there's going to be a move away from a lean inventory management approach to a more conservative approach in stock management, and that's going to impact on stock levels, certainly from a safety stock perspective. And if you get that equation wrong in relation to where demand's going, it certainly starts to increase the cost of the business and put pressures on the cash and the working capital within an organisation. That often then leads to a discussion around the supply chain and the supplier management side of the business. Again, what we are seeing here from businesses that we work with is one size doesn't fit all. We're seeing businesses that are having to prop up their supply chain, including financially, as well as committing to stock orders moving forward. We have some of our clients that are needing to diversify and find alternatives to reduce risk in that supplier management side. All of that increases the overall cost of supply to customers, and certainly in this sort of a market, it's often very difficult to pass those sort of costs on to your customers. We are certainly seeing in some areas where there is more demand than the ability to meet from a supply perspective, and pricing certainly moves in that perspective, but it's certainly difficult when you're trying to figure out whether that market is going to hold that level of demand, whether that price is going to hold as well. So looking at supplier management and how you actively manage the supply chain is really critical where there is demand volatility, and it can have quite significant impacts on the business. Those two things generally also mean that there's a real need to focus on cash flow management. One of the things that I've seen over the past in previous recessions is that the cash cycles increase. The point at which you pay for stock to the point at which you receive cash coming in the other end from sales significantly extends out. You get your debtor days increasing, and you generally then manage creditor days accordingly where you can. That certainly puts pressure on the supply chain. That means that there needs to be working capital considerations in the business, and I'm sure everyone's heard that cash is certainly king in these sorts of times, and needing to understand where the cash is coming from and going to, and whether you've got enough cash in the business to meet that volatility is really important. If we think about all of that then, and we think about the scenarios that you're going to run and the decisions you're going to make as businesses, it's clear that margins are likely to be squeezed over time. A way of managing that is certainly around active cost management, and the agility to meet demand certainly pays off. If we think about Wesfarmers, when they were able to move into online sales and move their stock through a lot more quickly. They had a growth of 60% in terms of their sales in comparison to this time last year, and they were able to capture that demand. So understanding that whole supply chain to the customer and the demand equation, and then look at it from a scenario analysis from their perspective, they were able to make a good decision in moving down that digital path early. I guess what that then says, if we think about it in the context of this time, is that the business needs to be in a position to undertake a more continuous approach to analysing market and market scanning, and that is certainly a discipline in itself. Businesses are going to need to understand how to adapt and change their demand modelling. As I said, a lot of the traditional models don't necessarily work that well. Where there is volatility, and discrete modelling and segmentation across products and customers becomes really critical. So if you've got that ability to mine that data and then look at it on customer products, it becomes a stronger position for you to make decisions from. And ultimately how you run scenarios from that information across your business and make decisions in relation to inventory management, supply chain management, logistics and people, it becomes critical. Overall, if you understand what the decisions are going to be doing for the business, then you can protect the erosion of profits. You may not be able to necessarily pass on pricing in all instances in the short term, but over the long term that may need to happen where it's possible, given changes in your supply chain costs. And as I said, closely managing your cash is really critical. There are areas that you certainly can influence in this environment, but there are a lot of areas where you can't influence it, and the ability, for instance, to have debtors pay on time becomes increasingly difficult in these environments. So having a toolkit of people you can go to talk about working capital management, FX and other things becomes key, but also understanding the tools that you can apply to a business to help you make decisions, to help you analyze and understand different elements of your supply chain, your business and your customers is really important in protecting yourselves during these times. I'm going to stop there and pass it back to Lawrence. Thank you for listening to that, and I certainly look forward to any questions at the end.
Thanks, Matt. Really valuable advice, and it is really a case-by-case situation. Thanks for condensing all that expertise in a really short 10-minute snippet. So I'll implore everyone again, reach out to Matt after the webinar. We've got some Q&A session at the end, but there's a number of ways he can help you and help you improve cash flow and profitability. Next up is Kevin Leong from Lendcap. So Kevin's going to talk about a whole range of different finance options, innovations and products on the market. So without further ado, over to you, Kevin. We'll see you again in about 10 minutes. Sorry, Kevin, you're still on mute. Sorry, just got to, we'll kick off again with that.
Sorry about that. Yeah, I was saying again that, my name is Kevin Leong from Lendcap, and what we do is we do business advisory funding solutions for businesses, firstly, by understanding what you guys do, understand how the business works, and understanding the seasonalities, and then coming down to solutions of options available for finance. What we cover is trade finance, business debt restructuring, equipment and vehicle finance, and performance bond setups. Yeah, so into today's topic about payment terms and cash flow strategies post-COVID-19, what we find from our clientele in this point of market is that there are a few issues being faced, the main one being reduction in supplier payment terms, especially in the construction industry. We see that a lot of clients were provided 30 to 60 days terms, but now they've changed into COD options available. There's also an increase in freight costs during this period as well. Limited commercial freight options available for air flights, which have cost to the increase, and overstock of supplies as well, whereby some of my clients, what they've had encountered is pre-orders which have not been sold or deposits just taken away, but basically they're left with the stock in hand and seeing how they can leverage off the stock to help with their cash flow at this point of time. So what solutions we've come up with in this market in more of a financial context compared to what was done earlier by Matthew is that we've looked at trade finance facility options available to them. So what that means is we've looked at invoice discounting options there, whereby they are able to get the cash up from payments made from invoices up front. This helps them repaying the rent, cash flow, and also wages requirements in the short term. We've also looked into getting clients options available for government-backed loans. So this is where they are unsecured facilities up to $250,000. 6-month repayment holidays available for those facilities as well. But the main thing to note in regards to these facilities there is banks are very, they need to know exactly what your next 12 months cash flow is and where the funds are going to be utilized. These facilities are most of the time as well, they're repaid within a 2.5-year period. So it's not that you're up for the full amount, it's more of what's used and what you can service as well as a business moving forward. Another thing to note about that as well is not just only the banks, but second tier and third tier banks are providing these government-backed loans as options available to you. So don't think that that's only done by the big 4 banks. it's a big variety of options available. The last one has been the bank repayment holidays, which I'm sure many of you know and are on if available. So a few key indicators that I find that is useful for businesses, like what Matthew covered earlier on, is the ability to understand where your business is at this point of time. Accounts receivable days gives you a good indication of where your invoices are in terms of how many days before you get paid. It's good to understand your current cycle and compare it to perhaps the previous financial year and perhaps what you expect for next year by doing a 3-way forecast. That gives you options available to see whether if the days are too high at the moment, you can look at options of perhaps giving discounts to your clientele in order to get them to pay you earlier. Accounts payable days as well, which allows you to understand where your supply invoices, when are they due. It's good to know when your main clinical or cyclical peaks and troughs are. So in that time, should you know that you're going to be short in cash, you might be able to set up a working capital facility perhaps in place for those periods of times to cover those shortfalls. Inventory days as well, good to help you out to work out your stock planning options available moving forward, which has also caused currently lead times to extend further. I thought it would be good to go through a few examples of my clients which have helped with funding options available in this period. So what the main first industry which I'm covering is the export wholesaler industry. Scenario being funding required for growth expansion. The main debtors were majority overseas, as you expect. That tends sometimes to be a problem with banks because they look at the strength of your balance sheet of your business, and if they won't be able to claim against debtors which are mostly overseas. But there are finance options out there which they take into consideration equity provided in by the directors and use that as a cost base, which allows them to get a bigger facility in place. They also leveraged off their suppliers, which are MNC companies, which entailed strengthen their case to get a supply finance option available to them. What this facility is provided to them as well was purchase discounts from the suppliers, being able to pay them upfront instead of 60 days, which might be a good way to control and help your margin erosion problems moving forward in this tough environment. The second example is a freight forwarder industry. Client required funds because of increase in demand during this period. But the issue there was that the business wasn't running for too long, within 24 months. We still managed to get a facility, non-bank facility for invoice financing that helped them, I guess, improve their cash flow and also cater to employ more staff, being it drivers during the time to take on more orders. So that's a facility limit in place. The third example, which I'm going to, is a medical equipment supplier. They supply equipment for pathology labs. What they had issues with was a lot of the clientele, the smaller ones, were unable to manage the cash flow to buy the medical equipment. So what we did was we got a merchant facility in place. It's similar to Afterpay for B2B. So what that did was allowed their clients to get a credit limit against the medical equipment supplier and repay that $150,000 medical equipment within a 12-month period with a 3-month interest-free period as well. So until it provided a revenue increase for the clients as well as cash flow options available. So just to summarize, just understanding your business is important in this period of time, seeing where you're at and how to plan for the future. Good to understand a bit of your credit debtors and creditors, your seasonality of your business, and where your cash flow is going to go to. To note that there's always alternative solutions to manage your cash, just speak to your trusted advisor, and we're here to help as well if you need our assistance. Thank you very much.
Great, thanks, Kevin. I appreciate that. And there's some really creative ways I've seen you work with clients, so definitely recommend all of you to reach out where you can and have a chat with Kevin about your particular situation. Just before we move on to our next speaker, James, I was remiss. I should have welcomed some of our industry partner members as well from ASCII, CBFCA, SILTA. So warm welcome to all of you, and thank you for joining. I should have said that from the outset. Apologies. Moving on, we're going to go to our expert with James King on all things Forex and other economic issues. So over to you, James. Chat with you soon.
Great, thanks, Lawrence. All right, bear with me, guys. Just getting this underway. Thanks for having me on here today, Lawrence. It's great to be able to speak here to all the viewers. Looking at all the different presenters that we've got on today, you can see a lot of real synergies between each, and how as a collective unit, you can see a lot of real tangible value to businesses, especially for those that have a global exposure. Works, guys. I wanted to start off with just looking at a few, firstly, considerations. Looking at it from an FX perspective around, the prospect there from a supply chain perspective of looking to perhaps change the way in which businesses are operating, looking at potentially changing suppliers, which case there could be some some issues from taking business from one country to another. Could be intra-country, of course, but if there's another country involved from a supplier perspective, there can be other considerations for businesses to think about, particularly looking at what currencies are involved in terms of what the suppliers want to receive. US dollars, of course, is the traditional trade currency for a lot of countries out there, but we're starting to see, and it's becoming a lot more common for various suppliers overseas to want to be receiving their local currency as an alternative to the US dollar. We're seeing currencies like the Chinese renminbi, it could be the Thai baht, Malaysian ringgit, Filipino peso, whatever it might be. We're starting to see a lot more of those exotic currencies starting to be used. And I guess the key to that is really understanding from a business perspective whether there can be some cost savings from looking at alternative currencies as well. We often ask our clients and prospective businesses to review, maybe via a dual currency invoice, so that we can do a live assessment of which currency would be cheaper for them to make that payment. And sometimes you can find a good sort of 2 or 3% difference between those currencies, and which over the course of a year can add up to some significant cost savings by exploring that. So that's just an area of opportunity for some potential businesses when they're looking at changing suppliers. Other things to consider are looking at payment terms, what ramifications that going to have from a working capital perspective. And just hearing some of the conversations there from a trade finance perspective, are there some other products that can be used to align quite closely with the way in which you're wanting to run your business in that regard. Are there going to be any change in volumes from a currency perspective by changing supply chain? Does that impact existing contracts that you've got in place? Do you need to have a more flexible hedge strategy that doesn't necessarily lock you into a fixed amount, and needing to have some flexibility around payment and payment dates, etc.? They're all sort of things that tie into coming up with a solution that helps you address the overall picture of the scenario. In terms of what's important to businesses, I mean, there's a lot of things, right, that are very important, and we understand that sometimes FX can be thrown to the back of the pile, and it's not necessarily the most important thing that a business wants to focus on. in regards to importers, of course, you know, that generally speaking, the biggest cost item on a profit and loss statement would normally be their cost of goods sold. So the FX does have a considerable, you know, impact on a business. So what we suggested to a lot of our customers and prospective businesses is by aligning yourself with professionals in this space, it enables you to effectively continue doing the myriad and the plethora of other things that you're doing in your business, but knowing that you've got professionals there that can look after certain aspects within your business, and FX is one of those. You know, what's important to businesses, looking at risk management, and this is something that I think is really important for a lot of businesses out there. I think that what we've seen in the last few months in particular, with the way in which the markets have behaved, there's been a lot of you know, extreme movements in markets that have created unnecessary risks for a lot of businesses. There's businesses out there that have been perhaps trading by dealing at spot, not having a risk management plan in place, and you know, they've seen I guess the purchasing power of the Aussie dollar fall from, you know, around sort of 70 cents, got down to 55 cents. It is back trading near that 70-cent mark at the moment, but that all happened in a very, you know, I guess an abrupt manner, and a lot of businesses were left having to pay bills that were suddenly a good sort of 20% more expensive than what they were previously. So having a proactive risk management strategy, it can be really important for business to mitigate that risk and of course to protect gross profit margins, which you know, in businesses, gross profit margins can be used, you know, in so many different ways. If you can increase those profit margins, it can be used to employ more people in the business. It might be used to even offer discounts for products, which you know, in these current tough economic times can be of real competitive advantage to a lot of businesses. So they're things that we like to consider when we're doing a holistic review with a business as to how we can really add value in that regard. I spoke about this a little bit before around flexibility and you know, perhaps making sure you've got you know, a combination of products that you're using via a risk management strategy to give you an overall you know, I guess best practice sort of you know, overarching products in place. And the aim there is to ensure that you've got both protection, but also you've got flexibility in your strategy. And whether that's from a, you know, product perspective, or just whether that's just from the way in which you go about conducting your FX on a day-to-day basis as well. Yeah, and the third thing that I find is really important is really, you know, the expertise side of things, making sure that you're working with experts in their respective fields that can help with providing information, content that can enable you to make really informed decisions within your business. So I think that's really important, especially in the current environment. And finally, just in terms of the application, you know, really wanting to understand within a business as to whether the FX strategy they employ does in fact align with the way in which their business operates. Often there's a misalignment, and that just creates unnecessary risks. So we can do an assessment and make sure that it does align, and then you can sleep at night knowing that you know, that the risk management and the FX side of things is under control. And the final point, of course, is to, you know, by that assessment, is to work out whether there's any efficiencies that we can make within a business and free up time and money. All important things right now that will help businesses you know, sort of circumnavigate the current economic climate. And just, I mean, that's it from me today, guys. Just an opportunity there to give a bit of a quick overview. Unfortunately, the FX side of things, I could talk about this for hours and hours, but wanting to keep it as confined as possible, but happy to take some questions in the post webinar session. Thank you.
Thanks, James. Really appreciate that, mate. And there's a whole range of expertise that we're trying to cram in, but we've got a couple of questions coming through. Just to remind everyone, we'll get to those very shortly after Phil's presentation. I've got a few come through on email, and we've got a few on the Q&A chat as well. So without further ado, we'll move over to Phil Smith from Export Finance Australia, and we'll come back and see you very soon. We'll kick off the Q&A. Cheers.
Okay, thanks, Lawrence. Hopefully everyone can see the screen there. So I've got 9 slides in 10 minutes, so hopefully I've got the ratio right. We'll keep it moving fairly quickly. So Export Finance Australia, some of you may know us as, or previously known as AFEX, recently sort of rebranded to try and, I guess, make sure our name actually explains exactly what we do. So we are about finance for Australian businesses who are exporting. So we're the Australian government's export credit agency, and essentially finance solutions around, or helping businesses, secure their export contracts. If there's expansion offshore and or onshore, term loan funding to support those types of opportunities. If you're an Australian business and you aren't a direct exporter but are part of an export supply chain, we are able to support and assist you. And we've got a bit of a focus, or have over the last couple of years, around helping deliver sustainable infrastructure into the Pacific, with some of their investment in that area. So we are, although we are a federal government corporate Commonwealth entity is what they call us, we do operate on a commercial basis, so we're not taxpayer funded. We actually go to the financial markets and raise our capital, obviously make the loans, take a risk margin, and we are for profit. Interestingly, the government, federal government, takes a dividend back from export finance each year. Let's move to the next slide. So how do we work with you? As I said, the finance products are really in these 4 categories. So working capital for your export contracts, so small businesses or SMEs that win a contract and need some working capital to close out that working capital cycle for their supply and their buyer is a typical solution for us. We do term loans, as I said, around CapEx for onshore. So if you're an exporter and you need to expand your business here in Australia, that could be equipment or property, then we can help with that, so long as your throughput is for export, or the majority of it is for export. We also help a lot of businesses on bonding, or some of you may know them as bank guarantees, which typically banks require 100% cash cover on, and we can do them for around 20% cash cover. So you can imagine you're winning export contracts and having to provide these guarantees for all of your contracts. It soon consumes your cash and working capital. So taking that off the table and allowing businesses to use their banking facilities for other areas is a solution we often provide. The corporate finance is really the structured and project finance type transactions, usually the bigger transactions into sort of emerging economies. We have a small corporate team based in Sydney that run those types of deals, usually large sort of sovereign transactions. Our process, fairly similar to a commercial bank, although we take a different view on the risk profile. So we're largely an unsecured financier, so we're not necessarily looking for property security. And we obviously fund earlier in the operating cycle, which is the piece that the banks typically are more challenged around. We look at a fairly detailed technical assessment, and the ability of the business to deliver on the contract is key for us. I just put a couple of types of businesses that we support. We're not industry agnostic, so we cover all industries, and there's no restriction on industry. So here's a quick sample of a few businesses that we've recently helped, which cover advanced manufacturing. CCB and Vico are a services company providing engineering solutions into the Pacific for some of their infrastructure. Babe Australia is a cosmetics exporter, manufacturer and exporter. Alpha Box and Dice are a wine exporter. Broadsource, as you can see, are IT solutions company, and Down Under Enterprises grow, package and export native Australian essential oils and botanicals for the sort of personal and home care sector. So all sorts of businesses, all sizes, and our loan sizes from anywhere from 25k up to about 50 million and everything in between. We do have at the moment, we have been allocated $500 million from the federal government to support businesses who are COVID-19 impacted, called the Export Capital Facility. So I won't go through all the details there, but essentially, you know, access to $500 million for loans of between $250,000 and $250,000 and $50 million for exporters or exporters in a supply chain. Some eligibility criteria there, really. One of the last 2 financial years, you need to have been profitable, and we need to have sort of a business plan or a cash flow evidencing your sort of recovery out of the COVID situation. Very busy in that area at the moment, helping and supporting a number of businesses through this. One thing I want to highlight, we've got some great resources, so I won't go through them all now, but we've got some great ebooks. There's some examples there on the screen, but we've got ebooks on various industries, all sorts of industries. We've got country ebooks on, you know, obviously a number of countries that we're experiencing exporting to, and some specialist papers around, you know, protecting your IP overseas. So I think the website's there, the link, and encourage you to have a look at that if you're looking for some guidance. So for me, sort of key messages from me, we are for export finance specifically, all industries. Obviously, advanced manufacturing seems to be quite big for us here in Victoria, but we cover all sorts of industries across the country. We don't necessarily compete with the private market, and typically we work with your bank to find the right solution. We get lots of referrals from banks to support businesses or their customers that they're unable to support. As I've said, the solutions are from small to large, 25,000 to 50 million and everything in between. And as I said, we're really focused on supporting Australian businesses that are exporting. And Lawrence has asked, there's a contact page, which I think we'll find some way of circulating to everyone so we can have a more personal conversation if required. Thank you.
Thanks so much, Phil. Great. Just so before we kick into the Q&A session, firstly, thanks to all the expert speakers. I know it's been a tough ask to try and condense so much expertise and knowledge into a 10-minute bite-sized snippet. So thanks for working with me on that. We just want to, as all of you, as the audience can tell, each of our speakers have got really complementary skill sets and products and services. So collectively, it's a real powerhouse of how they can help your businesses. So they all got really unique capabilities and all worth talking to in their own right. So we're just going to kick off with the Q&A session. Just before I go into the webinar, there's 2 emails that came through, so I'll just kick off those. Okay, the first one, a question from Taris is, and any of the panelists can answer these, is there an expectation or does anyone believe that the government will extend the JobKeeper payments beyond September? I'm not sure who's best positioned to answer that one, maybe Matt or James, I'm not sure.
My initial thoughts on it, I'll jump in on it before you do, Matt, but my thoughts are that they won't be extending it beyond September. That seems to be the narrative so far. I mean, they're already talking about what, culling it in certain industries, the childcare sector, it's been spoken about recently. I think that they're busy scrambling, the government trying to come up with alternatives alternative spending measures they will use to try and stimulate the economy. And as such, to me, the JobKeeper will finish up in September. Well, the ramifications of it yet to be seen, but who knows? It could be an interesting time around September, October.
Great, thanks, James. Matt, do you want to answer that at all?
Yeah, I'd agree with James. I think the government have turned their mind to where they can put money into stimulus around industries now in different ways, rather than from a JobKeeper perspective. I think the timing, if the economy starts to pick back up as a result of coming out of a sort of lockdown, and even the discussion about borders opening up, then you're going to see demand starting to move again in different ways. And I think an industry specific stimulus is probably more on their agenda, similar to what they've done around the construction industry, for example, and looking at that. And I think their money will be focused on those areas. I think how you do that is a much more difficult question to answer than something like a JobKeeper payment, which is more of an interim support measure than necessarily something that stimulates demand in an economy. So yeah, I'd agree with James.
Okay.
Government are going to be looking more and more around stimulation than something like a JobKeeper support.
Great, thanks. Phil, mate, this one might be good for you to answer. If international flights aren't really recommencing in a big way soon, there's going to be a significant impact on air freight rates and air cargo volumes. So that's going to really, especially from an export point of view, if you look at our fresh food and so forth that goes out as exports, do you see that therefore profitability, cost to serve, cost of those goods, maybe Matt, you want to touch on this as well, but there's going to be a significant impact on bottom lines, especially for exporters with increased air freight prices because of the reduced air cargo volumes?
Yeah, we're already seeing businesses who are coming to us with these sorts of problems with international borders closed. So, goods that are in transit or and so forth, and payment and profitability of that is being impacted. So, yeah, absolutely, it's a real challenge, and there's no clarity, I don't think, at this point in time, or certainty about when international borders are actually going to open, other than the stories around New Zealand and the Pacific at the moment. That's all we're hearing. So yeah, I would agree.
Yeah, and Matt, I know you touched on this as part of your opener, that essentially all the supply chain costs have to be rethought and remodeled as part of the whole overall strategy around supply chain costs. And this is a direct example of that, where air freight prices have gone through the roof. Local transport prices, the only good thing that seems to have happened out of this whole situation is fuel prices have reduced. But apart from that, everything's gone up. Have you got a lot of clients experiencing that, where the whole cost modelling across their transport distribution has changed altogether?
I certainly think you're seeing costs increase along all the way along the supply chain. That's just one area. I think that extends also to the ability to actually get stock into the country. So I touched on that example of where you can't get a chassis into the country to actually build a bus now. That's an industry that has contracted requirements to put new buses on the road to keep the passengers going round and round to their jobs. Now, if you can't put a bus on the road, there's a big pent-up demand that's going to occur at some point down the track. I think there's two sides to that. That yes, the costs are going up, and how a business then finances that to get the products to the customers. It then comes to what sort of level of pricing impact that's going to have, and that's where the margin erosion comes from. Your costs go up, but your sales price remains the same, or has a downward pressure on it. There's a real balance that businesses are going to have to find around the costs of that product, and then ultimately what they're going to pass on in the marketplace. The amount of demand out there is also going to weigh in on that equation. The cost might go up, the demand might go down. Finding that right point means that you should maximize the profit, whatever that profit point is for a particular business. How you change that cost equation is the difficult one, where there is a constraint in place, like an international border closed.
I think that, and James touched on some really valuable points I made some notes on as well, is that what you've just highlighted there, Matt, is what I call the importance of the 1%ers. If all this erosion is taking place between your customer price or your sale price is fixed and your supply chain cost is creeping up, getting higher and higher, those 1%ers, whether it's Forex, warehousing, transport cost, finance costs, that all adds up in a massive way, because that's what's going to reduce that profit erosion. So those 1%ers and the risk management strategy piece is really important. I'll just go to the next question. So I'll just go from a chronological order here. How relevant are supply chain skills in Australia compared to the US? That was from Imtiaz. I'm not sure who wants to cover that.
Lawrence, I think I know the article that's being referred to there.
Okay.
Certainly inventory management is going to be front and center for anyone who has to manage inventory right now. And the skills I think that they're talking about there are some of the more advanced techniques around getting sort of advanced algorithms to the point that you can put inventory in a location where demand's going to occur. Certainly the skills are relevant. I think that the real difficulty in this time is that we're talking about such significant uncertainty and volatility that the best modelling techniques out there often work off historical information, and this sort of volatility makes it very difficult to sit there and say, I'm going to rely solely on a model or an algorithm that you're introducing into the marketplace. I think where it'll come into it often, certainly from my experience, is more around how you manage inventory from a lean versus a sort of a conservatism perspective, and just the traditional sort of safety stock levels are going to increase until people get their heads around the right model for the new world moving forward, whatever that might be, until it changes again.
Yeah, great.
So it's certainly relevant, and inventory management and supply chain management will be a differentiator where you can't control demand and pricing.
Yeah, well, that leads into our next question from Monique from ASCII. It's essentially, a lot of practitioners have got a finance background in supply chain, but for those who have not come across from finance, what training would the panel recommend to fill these skill gaps to give them a more holistic supply chain management career? So you've sort of just touched on that, Phil, sorry, Matt, but if anyone else wants to cover those, any type of critical workshops or training or sessions that people will recommend? No? Okay.
I'm happy to jump in there. Look, again, a whole of business needs to understand, all aspects of, the sales cycle through to the supply cycle and the organisation in between. A broad-based management and finance style underpinning course, which gives you a holistic view of what a business needs to face in making these decisions, will enhance anyone who's looking for a supply chain specific career.
Well, I think definitely to add to that, Matt, what I've noticed as part of this whole pandemic is the wake-up call, if you like, about how important supply chain is to a business. In the past, it's been out of sight, out of mind. They don't really care what's happening in the warehouse. They're really looking at the sales dollars and the marketing and all the rest of it. But I can definitely vouch firsthand with the type of discussions I have on a daily basis that supply chain is now very much top of the agenda. It's actually got a seat, if you like, at the boardroom table, the executive table, where it may not have in the past, which really leads into a lot of the ASCII programs that they run as well. So, right.
Just to add to that there, Lawrence, as well, I was just going to say that, depending on the size of the business, you might have specific people that their job is solely to focus on supply chain within an organisation, which is fine, and then having a dedicated course that they complete might be appropriate. But for those businesses that aren't maybe so big, and the person that is looking after it also looks after a number of other facets within the business, rather than looking to specialise in 10, 15 different areas of the business, it might be an opportunity for them to really align with businesses like Pitcher Partners who are those specialists in that area, and they can provide that holistic advice anyway. As with a number of other areas, of course, as well, not just with supply management, but Matt and his team, stay at the forefront of all the updated information in that regard. So, to me, they'd be your best bet to really partner with those organisations.
Yeah,
Yeah.
agreed, James.
I think I'd add one extra thing is data analytics is going to come to the forefront here in supply chain. You know, the ability to mine data around customers, products, and help that to formulate decision making. I think is going to be certainly a big part of what businesses are starting to look at.
Yeah, and just I want to ask Kevin yourself, mate. That agility, the flexibility around having some, let's say, tools in your toolbox from a finance perspective, if you quickly need to move to another supplier or need to be able to offer some different payment terms or strategies around that, are you finding that's really become a whole new way of having agile supply chain, but also the ability to have flexible finance options? Because even if you're being a long-term customer of the Big Four, you might need to quickly do an emergency purchase or offer some special deals to move some stock on. Are you finding that companies are looking for some more creative financing, Kevin?
I guess it's working together with the banks as well in terms of they can provide your majority share of funding, but let's say if they can't provide you further funding than that, that's where the options are available in the market, where we can go to other trade finance companies which can provide the additional top up which you require. So that kind of controls the cost limitations of how much it costs for the bank. It's always cheaper to go to the majors, but it's if there is the need, the urgent need to win a certain contract, we can look to fulfill that in the term and get it done in like a 2 or 3 week period.
I think what we class as opportunity cost, right? Well, so that's where, you know, if you're going to prepare an opportunity, and Phil, I'm sure you live this on a daily basis with your clients, if you've got a window to secure a contract and, you know, your traditional lenders or your traditional providers are going to take a longer lead time to get that done, sometimes you just got to bite the bullet, at least have a few other options up your sleeve.
Yeah, I can comment on that. We see that every day, and you stole my thunder there a little bit around opportunity cost, because that's exactly what it is, right? It's you know, how do we help businesses you know, grow their existing clients, grow to new clients, you know, leverage that, and look our costs are similar to the bank, not exorbitant. So there's a small premium because, of course, for us, if businesses can get finance from their bank, that's where they should go. But when that becomes, you know, challenging or for them, then we've got a role to play. So yeah, it's all about, I guess, alternatives and flexibility, as you say, and being agile, and you know, partnering with the bank, as well as Kevin said, can often work for the business, the bank and ourselves, to come up with a kind of a collaborative solution for the business.
I think that's what we're finding with our clients is that essentially that holistic approach, and that word's come up a few times by all of you today, is that, you know, if you're with a one-stop shop with a bank, that may have worked quite well because you got buffer, you got a level of comfort in that. But now, when you're trying to really ring the towel on not just supply chain but finance and costings, you really need to go to specialist teams, and the specialists like AFEX who can, you know, get, as I said before, the 1-2% differences that you may not get from a bank. You know, people like yourself who can tap into the export finance extra support programs and that the bonds or bank guarantee capability that they may not have needed before, or even working out a proper strategy when you're looking at your proper landed costing and pricing that Matt and his team do as well. So it's a whole range of rethinking that's taking place. Unfortunately, it's taking place very reactively versus proactively, which is what I wanted to ask the panel. For those companies that you've worked with, and all of you work with varying degrees of expertise and maturity when it comes to importers and exporters, those, I mean, one would assume that those who have been more strategic, more structured, more prepared are actually riding the wave of this uncertainty better than those who have been, you know, reactive. So are there any, you know, key takeaways over and above what you presented in your slides, that the lessons learned, if you like, for people who haven't invested in cash flow strategy, profit strategy, because that is I just want to ask the group, so maybe I'll ask with you from an exporter's point of view. Exporters really normally operate at very lean profit margins. do they have to rethink the whole pricing to allow buffers in the future from here on?
That's not necessarily what we see. I mean, some good, it's surprising what we do export and do well here, both in goods and services. And I would say a lot of the time the margins, the GPs, are actually quite high. And so for those few businesses where there are leaner margins, then obviously the additional costs sometimes can be prohibitive rather than opportunity. But that's more the exception than the rule. But the businesses that we've been working with more recently through this COVID pandemic, what's been interesting is those that came to us at the end of March were those businesses that you just reflected. They were on it so quickly. They had all their financials. They knew what was happening. They'd already spoken to their supply chain, buyers, suppliers, and they had a plan and they needed some working capital to get through it. Whereas 9 weeks later, now we're getting some businesses coming to us going, well, we didn't think it was going to be a problem, and so then we're having to work with those businesses a bit more closely around, well, you need to, we think we can help, but we need to understand your forward planning and how you're going to recover and what does your cash flow look like. And so some of the smaller businesses don't just have, as the guys know, access to this sort of financial sort of information. So yeah, I would agree that businesses who have a good handle and a good grasp of their supply chain, if you want to call it that as well, through a financial lens, are typically the ones that can respond quickly to a situation like this.
Yeah. And Matt, can I ask you on this note? It's because Phil's given me another question that I wanted to run by the panel. So obviously with every crisis, there's an equal opportunity. Have you seen many of your clients, Matt, that have been able to, we'll use that buzzword, pivot and actually, win out of this situation?
I think there are examples already out there that most people have seen or know about. The likes of the restaurant industry able to pivot pretty quickly and put in place a new digital chain around delivery of what they do. People who have, I used the Westfarm as example, able to get their digital initiative and their logistics to increase their home delivery service and those sorts of things. Anyone who's been able to pivot their business to react to the way the market is engaging with you in a very, very short space of time. So not taking 6-8 months to put on a project, but able to put up a business which is able to have orders taken, cash received, that to integrate back into your business, to your supply chain, so that your demand can be met. They're the ones who are capturing the opportunity in this time, because that's where the demand is coming from, and it's not necessarily from a traditional source. I think Phil made some really valid points around those businesses who are constantly market scanning, who have the business planning and the three-way models that Kevin mentioned around what the financial implications are for the business, are better able to make decisions quicker as a result of something that is not just on the horizon but impacting today. If you don't have that expertise or those skills, then what happens is you have to build them up, and by that stage you're 6-8 weeks down the track, and then you're in a position to make a decision. So I think it's they're skills that all businesses need to start employing if they're not doing it already, and those that are doing it are the ones that are able to make a decision around pivoting or capturing opportunities.
Great, thanks, Matt. James, I've got a question for you, mate. Everyone knows what's going on around the tensions between China and Australia. There's been a wake-up call from that supply chain dependency, if you like, in late February, early March, when everything stopped coming through. And I know you touched on with your presentation, different currencies. Have you noticed a lot of your clientele with AFEX looking at different markets and scrambling to find new supply sources and even new export customers outside of those traditional markets?
Look, we are seeing it, Lawrence, but traditionally when it comes to switching suppliers, it's not something you can just do in a day or in a week or a month. It takes time. So the concept for a lot of businesses to look outside of their traditional supplier models has only really sort of, hit the headlines in the last month, 2 months, really. So it's just insufficient time at this stage. When you think about it, you've got to find a new supplier, you've got to sample products, etc. You've got to quality control. There's a lot that goes into it, and it's just too early to really assess that just yet. But it wouldn't surprise me if in the coming in the coming months and the second half of the year, we do start to see a lot of businesses change suppliers and potentially change currencies and locations to where they're sending funds. It will happen, but it's just a slow process.
Yeah, and the risk mitigation part that you mentioned, James, in your presentation, in currency, again, people have been quite comfortable and complacent, but when you look at the statistics that you talked about, I think it's been the last 10 months, the fluctuation for the Aussie to US has been massive in 10 months. And people are still very reactive. This is also a wake-up call when you look at cash flow, profitability, to put in place strategies and products that can actually buffer them in a massive way that people are sort of, unfortunately in Australia versus other markets like Europe and the US, where they are more proactive in strategic LCs, trade credit finance, Forex cover, forward cover. They do a lot more proactive risk mitigation in most markets. Why don't Australia do as well?
Yeah, it's interesting that last statement then just threw me there, Lawrence, that we don't do it as well. I think there are examples of businesses that certainly do it well. It's not it's not across the board that would be the case. There's certainly examples of opportunities for businesses to do things differently. I guess with the way the market reacted, and I'll talk about it from an importer's perspective. First of all, for those importers that were proactive throughout the year and had taken proactive cover, they actually didn't have to do anything during the last few months when the Aussie effectively crapped itself, and they were able to ride out the market volatility by having that proactive strategy. And in fact, it's really only those that reacted when the currency started to move and started to put in place risk management strategies either at the bottom of the market or perhaps at a midpoint between the bottom and the top, that are now sort of looking back and going, well, had we had a more proactive stance, then we might not be in the position we found ourselves in today, given that we've seen a V-shaped recovery in the currencies. And look, for those exporters, I mean, there's certainly some opportunistic, purchasing of currency, over the last few months, where I know of a lot of businesses that exporting businesses that took advantage of the Australian dollar when it dipped below 60 cents momentarily, and those that took that opportunity certainly got a competitive advantage, or at least they're able to use that FX gain to offset other issues that they're seeing within their businesses right now, from logistics, supply chain, etc. So yeah, I think the theme being that those businesses that do adopt a more proactive strategy often will have the better results.
Yeah, thanks, mate. And Kevin, on that point, I wanted to cycle back to yourself there with trade risk, trade cover, non-bank lenders. I mean, I know that if you've got trade credit insurance, you can typically tap into some other funding that you may not be able to get. But also what that does is, to what James mentioned before, it takes time to typically onboard new suppliers. But if you could offer better payment terms or lines of credit even to suppliers, therefore you can activate and pivot quite quickly. Are you finding that your clients or your customers are really trying to look at different trade credit combined with trade insurance type models?
Yeah, I see more options coming out in the market now for this trade insurance opportunities. There's one new one which has come into place, whereby effectively a newer business which currently is taking opportunities of the increase in medical supplies market to the country to cover those points. They're able to get the trade finance facilities insured against the supply side in China. So basically there is a business insurance which secures it against the limit They understand the main contract in place, and it's practically an unsecured facility.
Okay.
So there are different opportunities now in the market, which just depends on the strength of the contract. I think it is, at the end of the day, they would have options available to them.
Okay, great. I'm mindful of time. There's two other quick questions I'd like to get through from the Q&A panel. So what are some of the best way or practices to reduce supply chain costs that are not too complicated to implement? Does anyone have a stab at that? And how can we support suppliers and business partners with cash flow when there is so much uncertainty? Well, I suppose that's sort of been answered in a way about having an array of risk mitigation, which therefore can provide flexibility and agility to work with longer payment terms or faster scenarios with suppliers and or customers or business partners. But I'll open it up to the panel if anyone wants to cover those two questions.
I'll just cover off just one part regards to their supply chain finance options there. If they can get that in hand, what happens is they will help their suppliers as well by paying them upfront, being able to get perhaps a discount from their own suppliers. Instead of paying them 60 days, now they pay them upfront and asking for a discount in front. What that does is that should help with the margin erosion problem, which we have as well in the onset. So that's one way of mitigating and managing it.
Okay. Any other advice on some best ways or practices to reduce supply chain costs that aren't too complicated, a bit realistic? I think my 2 cents on that before we go to the panel is, really looking at what Matt was discussing before. The notes I've made across the presentations is that it's very clear the companies have got a really good understanding and up-to-date understanding of what their inventory levels are, what their supply chain milestones are, and they're really up-to-date with the clarity across their supply chain and cash flow are going to reduce the costs in a very quick and rapid way because they understand it better. Those who are guessing and who don't have enough clarity across their data sets are the ones who are paying more when they don't need to. So that's my 2 cents, but I'll open up to the panel.
Yeah.
Oh, sorry, Matty.
So thanks, Phil. I was just going to say, look, I think, Lawrence, your comment around the 1%ers right now is probably a very apt comment. And I think you work back through your supply chain costs, your warehousing costs, your inventory costs, your logistic costs. Look at the things that James and Kevin are talking about. You look at your AFEX if you're exposed there. You look at your finance facilities, and you look at the cost of working capital. All those areas I think you need to take a look at, because you trim a little bit here and a little bit there, and it adds up pretty quickly. To focus on sort of one or two, it just to me feels like you're sort of putting your eggs in one basket, and you're probably more likely to find 4 or 5 small things across the whole supply chain that'll make a difference to your margin.
Yep. Thanks, Matt. Phil, you want to add to that?
Pretty much similar to Matt. I mean, I would look at it as as a banker, it's through a financial lens. So it's looking at your working capital cycle and just going right from the supply side to the buyer side, and as Matt says, sort of looking across that and looking for those 3 or 4 smaller things that you can do on both sides to constrain that cycle as much as you can. Yeah.
And I think the other thing that really adds to those 1%ers is dealing with expertise. I mean, as Monique asked in that question, what's out there? Yes, you can train, you can learn, you can surround yourself with great associations who can provide education. But that all has a lead time on the learning curve. In addition to that, to tap into, as Matt, James, Phil all said, is to really go to people who are experts. And I'm reminded of the old Henry Ford statement, which has been done to death, I know. But you don't need to know everything. You just surround yourself with people who do. And that's really so true when it comes to the current crisis, that if you can get experts in Forex, in export finance, in strategy, in a whole range of non-lending products, those 1 or 2% can add up quite quickly to 5 to 10% across the board. So that, as you've all talked about, can make a make or break difference to profits in your supply chain and your business overall. So really important. I'm just looking at any other Q&As coming through. What I'll do is, we don't have anything live at the moment. Just a reminder to all the attendees and guests that this is being recorded. We will put it onto our YouTube channel. You'll all receive a link to it as well. So copy of the presentations. I know that there's been a question around that. You'll definitely get this whole presentation. If you need, or if you'd like to ask for a specific presentation for any of the guests, all their details will be on the post as well. Thanks, Imtiaz. Appreciate your feedback there on the chat. So any final words that I'll go around the room, virtual room. So Phil, any sort of departing words you want to sort of touch base on?
No, look, it's been a really good session. Thanks for the opportunity. Yeah, I think, you know, what I heard out of all that is, you know, be proactive, get on the front foot. As you said, you know, learn from others, surround yourself with people in all these areas because it's quite complex. Get across your numbers, you know, plan financially in your business. I think that's one key one that we often see. The businesses that are successful are the ones that are really across the detail around their finances. Mm-hmm. And therefore, as Matt said, you know, it enables them to make better decisions more quickly. So that'd be my parting advice.
Yep. Just before you go, Phil, one thing that's just come through on the Q&A, what advice would you have for young supply chain professionals? Now, I know you're export focused, but you've had a lot of supply chain experience and finance experience. Any tidbits of advice you want to share before we move on to James?
I'm not so young anymore, but look, I think Matt was right there as well around, you know, I think to limit yourself just to one area is limiting in itself. So, you know, a more general kind of learning opportunity, I think, gives you a better, sets you up better to make, you know, better decisions around the specific area that you're looking to focus in on. So I would say go, you know, more broad than specific on your learning.
Great. Yeah. Thanks, Phil. James, I'd like to turn to you, mate.
Yeah, I just wanted to say thanks for having me on today, Lawrence. It's really been enjoyable to present, but also to hear the other presenters as well. I've certainly learned a lot from this session as well. But I guess I'd just like to reiterate a point that's been made, you know, a few times, and that's just around, you know, surrounding yourself with professionals, the experts. You know, you don't think that you can do it all yourself, because you know, I think one element that we all undervalue is time, and the time that it takes for you to learn something that someone already knows can often mean that, you know, you're missing out on doing a number of other things within your business. So surround yourself with the experts, and they'll help guide you along the way.
Yeah, 100%, totally agree. Kevin, I'll move to you, mate.
Yep. Thanks again for your time, Lawrence, on this show, and with the panel as well. It's been great. Yeah, I would say just my parting words is, yeah, options are there in the market. Surrounding yourself with your accountant, AFEX provider, broker, specialist, that's going to make all the difference in your business. And like James said, time is money. That's about it.
Great. And Matt, I'll leave it to you to do the last parting words from yourself before we wrap up.
I'd echo everyone's comments there, and certainly, Lawrence, thank you for the opportunity. Again, from everyone's perspective and mine, it's been enjoyable to be part of the conversation. And I'm going to go a little bit left field and say, you know, one of the big, you know, best things you can learn in business is to be inquisitive and curious and passionate, and that generally leads to, you know, you seeking to understand more than just, you know, the area that you're making a decision on, and that really shows through when, you know, if you're understanding a decision in supply chain, it often has a long-term strategic decision on where you impact on the business. And so, to Phil's point, having that sort of generalist knowledge and understanding what the consequential impacts are going to be from a supply chain, a young professional in supply chain, then it can stand them in good stead when they understand the impact of what their decisions make. So, you know, you move a lead time out, what's that going to mean ultimately in meeting demand moving forward? Or, you know, you make a decision like James said around FX, and what does that mean in terms of safety, protection and risk management? Or to Phil's point around, you know, looking at diversified opportunities for finance and Kevin. So I think natural inquisitiveness and passion really does help anyone who's young and entering a profession.
Great, thanks, Matt. Really great words, and I think neither of us, maybe Kevin, you probably look the youngest out of all of us, but yeah, definitely staying inquisitive, staying interested pays itself in spades. So I'll just in one final call out to the audience. If there's any Q&A, let us know. Otherwise, we're about to wrap up. Thank you again to all the panelists: Phil Smith from Export Finance Australia, Matt Wilson from Pitcher Partners, Kevin from Lendcap, James from AFEX. Really delighted to be able to bring you these expertise, that sort of knowledge. And, you know, we say knowledge is power, data is king these days. But apart from all those things, for us to help companies stay business, stay profitable and survive through this pandemic, and actually grow through this pandemic where the opportunities lies as well. That's what ATLC is all about. Really strongly encourage you all to discuss your own individual questions, needs with each of these panelists. They can all add value to your business, to your knowledge, and help you in growing your business faster and smarter globally. So thanks everyone. Hope you've enjoyed today's webinar and look forward to being in front of you again with some great other experts and new speakers as well. Thanks again to the panelists, and we'll look forward to keeping in touch, and we'll see you all very soon.